Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Wednesday, April 29th, 2026, and we've got quite a bit to unpack today with the Fed decision looming, oil prices surging, and some major corporate moves shaking up the markets. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the dominant story right now is this oil price surge that's got everyone on edge. We're seeing Brent crude topping $114 per barrel, and that's extending a multi-day rally driven by escalating geopolitical tensions, particularly with Trump issuing new threats to Iran. This is creating a significant risk-off sentiment across markets because traders are starting to price in the possibility of a broader economic slowdown if energy costs continue climbing. We're also seeing some interesting divergence in corporate earnings. Yum Brands came out with numbers that topped estimates, driven by Taco Bell's impressive 8% same-store sales growth, which shows consumer spending in the fast food sector remains resilient. On the flip side, SoFi met expectations on their lending records, but their tech platform struggled, which is why the stock is pulling back despite setting those records. Then we've got this massive M&A wave with Finland's Kono agreeing to buy TK Elevator for $29.4 billion and Chiesi acquiring Calvista Pharmaceuticals for $1.9 billion. What's particularly notable is Total's profits jumping 29%, driven by these war-related oil price increases and trading gains, which really underscores how energy companies are benefiting from this geopolitical instability.
That oil situation is certainly creating some anxiety. We're also seeing stock futures wavering ahead of the Fed decision today. What does this mean for traders and investors navigating these crosscurrents?
The key here is understanding that we're in a very delicate positioning environment. With the Fed decision coming today, traders are hesitant to make big directional bets until we get clarity on the policy path forward. The rising oil prices are particularly problematic because they reignite inflation concerns right when the Fed might be looking to signal a more accommodative stance. For active traders, the strategy right now should be focused on sector rotation rather than broad market exposure. Energy stocks are obviously benefiting from the crude rally, and we're seeing that with Total's numbers, but consumer discretionary is showing mixed signals, with Yum Brands performing well while others struggle. The tech sector is trying to rebound ahead of mega-cap earnings, which is interesting because we've got this setup where investors are hoping big tech can provide some positive momentum to offset macro concerns. One particularly encouraging development is that emerging market stocks hit record highs, driven by Asian chipmakers surging, which suggests there's still risk appetite in certain pockets of the global market. The mortgage market is also showing signs of life, with home buyers trickling back despite rates rising again, which indicates some resilience in housing demand.
Let's talk about the indices specifically. How are you reading the technical setup for the major benchmarks?
Looking at the S&P 100, we're seeing some consolidation near recent highs, but the oil price surge is creating resistance. The index is holding above key moving averages, which is constructive, but we need to see how it reacts to the Fed decision today. If we get a dovish surprise, I'd expect a push higher, but if Powell sounds concerned about inflation, given these oil prices, we could see a test of support around the 50-day moving average. For the Nasdaq, the technical picture is more interesting because we've got this rebound happening ahead of mega-cap earnings. The index is trying to break through some near-term resistance, and there's clearly buying interest in tech stocks despite the macro headwinds. However, volume has been relatively light, which suggests conviction isn't particularly strong. The key level to watch is whether we can hold above the recent consolidation range. The Dow is actually showing relative strength compared to the other indices, which makes sense given its heavier weighting toward value and dividend-paying stocks. In an environment where growth is uncertain and oil prices are rising, investors tend to rotate into more defensive names, and that's benefiting the Dow. The index is trading near the upper end of its recent range, and if we can get through current resistance, there's room to run toward new highs.
That sector rotation you mentioned is really important for investors to understand. Are there specific areas you're watching more closely?
Absolutely, energy is the obvious winner right now with oil at these levels. But I'm also watching the financials closely, particularly with Wells Fargo's long-anticipated Wall Street expansion finally here. That's a significant development because it shows confidence in the capital markets business, even amid uncertainty. The rare earth stocks are also getting interesting as China looks to tighten production oversight, which could create supply constraints and support prices. On the consumer side, we're seeing this bifurcation where value-oriented concepts like Taco Bell are thriving, with 8% same-store sales growth, but higher-end discretionary spending might be under pressure. Etsy beat revenue estimates on steady demand, which suggests e-commerce remains healthy. The insurance sector is also worth noting because natural disasters are rewriting home insurance costs, and that's creating both challenges and opportunities depending on which companies can effectively price and manage that risk. One warning sign I'm paying attention to is Jamie Dimon's comments about a potential bond crisis ahead as global debt risks build. That's not something to ignore given his track record of identifying systemic risks.
Those are some significant considerations. Steve, let's shift to the economic calendar. What's the picture looking like with the Fed decision today and other data on the horizon?
Thanks, Robert. Today is obviously dominated by the Federal Reserve's interest rate decision, which is the most important economic event of the week. The market is expecting the Fed to hold rates steady, but the real focus is going to be on the statement language and Jerome Powell's press conference. Traders are looking for any hints about the policy path forward, particularly given these rising oil prices and what that means for the inflation outlook. The Fed has been in this data-dependent mode, and recent inflation readings have been mixed, so Powell's characterization of the current economic environment will be critical for market direction. Beyond today's Fed decision, we've got some important data coming later this week. The GDP report is due out, and economists are expecting moderate growth in the first quarter, but there's concern about whether that momentum can continue, given the headwinds from higher energy costs. We're also getting initial jobless claims data, which has been running relatively low, indicating the labor market remains tight. That's important because Fed officials have consistently said they need to see some softening in labor demand to feel confident that inflation is truly under control. Looking ahead to next week, we've got the employment situation report coming on Friday, which will be the big one. Non-farm payrolls, unemployment rate, and average hourly earnings will all give us a comprehensive picture of labor market health. The consensus is expecting solid job growth, but not so strong that it forces the Fed to reconsider their current stance. Average hourly earnings growth is particularly important because wage pressures feed directly into services inflation, which has been stickier than goods inflation.
The Fed certainly has a challenging communication task today, given these competing dynamics. What other economic indicators should we be monitoring?
Consumer confidence data is coming next week as well, and that's going to be important given what we're seeing with oil prices. When consumers fill up their gas tanks and see higher prices, it affects their perception of the economy and their willingness to spend. We've already seen some mixed signals from retail sales data in recent weeks, so consumer confidence will help clarify whether households are pulling back or remaining resilient. The other thing I'm watching closely is the housing data. We've got pending home sales and new home sales reports coming up, and mortgage applications have been showing some improvement despite rates rising again. That's a bit counterintuitive, but it suggests there's pent-up demand from buyers who have been sitting on the sidelines. If housing data continues to show resilience, that supports the case for a soft landing scenario. On the inflation front, we're getting the PCE price index next week, which is the Fed's preferred inflation gauge. This will be crucial because it comes after the Fed decision and will either validate or challenge whatever message Powell delivers today. Core PCE has been running close to the Fed's 2% target, but there's concern that rising energy costs could push headline inflation higher and potentially spill over into core measures. Manufacturing data is also on the calendar with the ISM Manufacturing Index. This has been in contraction territory on and off, and we need to see whether factory activity is stabilizing or deteriorating further. Global trade tensions and supply chain issues continue to affect manufacturers, so this report will give us insight into that sector's health.
That's a comprehensive look at what's ahead. Lizzie, let's talk crypto. What are you seeing in the digital asset markets?
The crypto market is showing some real stress right now, Robert. Bitcoin dropped below 76,000 one-week lows, testing key support levels, and the technical picture is looking increasingly bearish in the near term. What's particularly concerning is that the Coinbase premium turned negative, which indicates selling pressure from US institutional investors. We saw weekly losses exceeding 829 million oil, which suggests significant outflows from the space. The oil situation hitting $100 sparked fresh crisis fears that weighed on risk assets broadly, and crypto certainly falls into that category. However, there are some interesting crosscurrents. Paul Tudor-Jones came out calling Bitcoin the best inflation hedge, which provides some institutional validation for the long-term thesis. We're also seeing corporate strategy purchases continuing to drive some buying, according to Bitwise, though that hasn't been enough to offset the broader selling pressure. For next week, I'm looking at a neutral to bearish outlook for Bitcoin. The key level to watch is whether we can hold support around $74,000 to $76,000. If that breaks, we could see a move down to the $72,000 to $73,000 range on the upside. Bitcoin needs to reclaim $80,000 to shift the momentum back to bullish. The problem is, we've got multiple headwinds converging with the Fed decision uncertainty, geopolitical tensions, adding risk-off pressure, and the Clarity Act approval odds falling, which removes a potential regulatory catalyst.
What about Ethereum and Solana? How are they positioned relative to Bitcoin?
Ethereum is actually looking worse than Bitcoin right now. ETH fell to its lowest opening in over a week and is trading below the critical $2,000 psychological level, which is a bearish technical signal. What's adding to the risk is that we've got one whale riding $132 million in ETF leverage into resistance, which creates potential for cascading liquidations if price moves against that position. There was also an Aave-linked exploit that required a recovery plan for $293 million, which undermines confidence in the DeFi ecosystem. On the positive side, we're seeing increased investment in Ethereum staking infrastructure, with companies like SharpLink doubling down, which shows long-term conviction. For next week, I'd characterize Ethereum as bearish to neutral. The critical support is at $2,000, and if that fails, we're looking at $1,900 to $20,000 150. I'd avoid taking positions until we see a clear reclaim of $2,000 with conviction. Solana is actually the most interesting of the three because it's showing relative strength. We're seeing ecosystem expansion, with Chile's expanding to Solana and Base networks for fan token trading. And there's this World Cup fever driving adoption in the sports and entertainment sector. Solana's sentiment is neutral to bullish for next week, and it could be a relative outperformer if we see continued weakness in Bitcoin and Ethereum. The key difference is Solana is benefiting from actual usage growth and partnership announcements, rather than just macro trading.
How are you reading the institutional versus retail dynamic in Bitcoin right now?
That's a critical question because we're seeing a real divergence. On the institutional side, we've got continued validation from figures like Paul Tudor Jones and ongoing corporate treasury purchases that are providing a floor of demand. However, Adam Back made an important point that institutional money moves slower than people expect. So while that capital is coming, it's not going to create the rapid price appreciation that some traders are hoping for. The Coinbase premium turning negative is significant because it specifically measures US institutional flow, and that turning bearish is a warning sign. On the retail side, there's actually a social media groundswell predicting Bitcoin above $90,000, and that might be a problem because it suggests sentiment is getting frothy even as price is declining. When you see that disconnect between social sentiment and actual price action, it often indicates that retail is getting trapped in losing positions. The other factor is that we're approaching May, and there's this old trading adage about selling in May, which could create additional seasonal pressure. The institutional positioning seems to be more cautious right now, waiting for better entry points, while retail might be catching falling knives. For traders, the key is to follow the institutional flow rather than the social media hype. Watch the Coinbase premium, monitor the corporate treasury purchases, and pay attention to what the big players are actually doing with their capital, rather than what retail sentiment suggests should happen.
Well, that gives us a lot to think about as we head into this Fed decision and navigate these volatile markets. Remember, do your own research and consult with financial advisors before making investment decisions. The information we've discussed today is for educational purposes, and markets can move quickly based on new developments. If you found today's discussion valuable, please subscribe to the Morning Bell so you don't miss our daily market analysis. We'll be back tomorrow to break down the Fed's decision and how markets are responding. Until then, trade carefully and stay informed.